We have 90 around this webinar. Good afternoon, good morning, and hello from Ho Chi Minh. I'm Dominic, Chairman of Dragon Capital, and I'm here to introduce our second webinar on Vietnam and its path through the COVID pandemic. The format today is that we'll hear a macro update from Head of Research, Deputy CIO, Dr. Tuan, following which we'll hear CIO Bill Stoops share his views on the markets, what's been going on there. And then to drill down a little further, we have 4 of our senior analysts, each of whom will take one core sector, give an update, and talk about the companies that we own in those sectors. All of this will be drawn together by the Vail portfolio team, represented by DPM Tuan Bui, who will show how these ideas fit into the portfolio. For those of you not familiar with Zoom, I'd refer you to the Q&A button down the bottom of the screen. And we welcome and encourage all questions to come at whatever stage. Given the number now approaching 100, we may not get to everybody's question, but we will ensure that answers follow up in a written email. So Ho Chi Minh is hot. The rains happily have just broken, and the scent of earth is in the air, and there's a sense of cool relief in the streets. And today is a very special day. Today is the 130th birthday of Ho Chi Minh. That's an appropriate time, perhaps, to pay tribute to a truly remarkable set of national characteristics and values that have ensured that Vietnam has conducted a rigorous suppression campaign. And with the exception of a few oldies like me, has ensured that the entirety of the country is back at work and back at play. So these are the ideas we'll be hearing a little about today. Broadly speaking, COVID has been, of course, shocking, serious, but we anticipate that it's something rather short term. Partly as a result of that, the economy remains one of the best economies in emerging markets, and the equity markets, even on reduced forecasts, offer undemanding value. The much ballyhooed FOLs, foreign ownership limits, are being finessed through structured vehicles, and the risks overall appear to be external rather than domestic. Thank you all very much for giving up some of your time today. I know we're all probably a bit fed up with Zoom, but without further ado, let's head over to Dr. T. Unmask yourself, Dr. T.
Hello, everyone. So allow me to share my screen. Ladies and gentlemen, can you see my screen now?
Yes, we can.
Perfect. Regarding COVID-19 in Vietnam, I can summarize the situation in just one word. Wow. Vietnam has a long border with China, 250 flights per day from and to Korea and China, the biggest. But we have only 324 cases so far. More than 2/3 of those cases were imported, no death. We already have 30 days, no new cases locally. Vietnam did apply the strict social distancing from April 1st for 3 weeks already. The economy has been open since 23rd of April, and everything coming back to normal last week. So how did Vietnam do to contain the outbreak? What is a secret? The key secret was the number of tests per confirmed cases was the highest one globally, which is surprisingly 15 times higher than Korea, which will be seen a role model globally. Not only that, Vietnam was ranked number 1 globally in terms of the government response to COVID-19. They just used a right amount of measure, not too much, not too little. Not too little, so it didn't impact the economy much. However, despite the success in containing the virus, Vietnam's economy suffered from COVID-19. Hospitality sector was being the hardest hit. International arrival approaching zero from about 2 million people per month. Likewise, hotel occupancy down from 71% now to only 2%. More importantly, the passenger transportation locally, which is a proxy for domestic mobility or service sector, dropped 4%, a record low ever in April. Retail sales down 26% in April. Frankly, this is a good number because we shut down our economy for 3 weeks in April. How about the second sector, which is manufacturing sector? 2 months ago, we was very worried because Vietnam relied heavily on import material from China and Korea, almost 70 to 80%. Now, China and Korea reopened. That worry is no longer a worry. The new worry is the export market, the output volume. You look at in April, US, Europe, and many other countries shut down their economy, social distancing. So we wonder how the export market in Vietnam can perform. We was expecting the down for 20-25% on the last webinar. Now the result only down 4%, which is stunningly good in our view. Above that, we track the Google frequent data daily. We look at after the social distancing applied, how the domestic economy performs. You look at this, on the retail and recreation sector, it's bounced back very quickly, almost back to normal. Grocery and pharma, this you can call V-shaped recovery. On the domestic traveling, also bouncing back strongly. Workplaces, how people go back to work, it's not back to normal yet because there's still a big part of people working from home. But from this graph from Google, you can conclude the V-shaped domestic recovery in Vietnam is taking place. Now, how Vietnam compared to other emerging markets? First, you look at PMI in April. Vietnam is only behind the 2 countries which are not shutting down in April, China and Korea. In terms of export, I don't have the newest data for all the country, but so far in March, Vietnam performed extremely well against all the good emerging markets. Retail sale, we are one of the very best one in emerging market. If you compare ourselves with our competitor, meaning China +1 strategy accelerated, some country could receive the benefit, which may be India, the Philippines, Indo, or Vietnam. But let's look at the stability, the robust of the 2 countries, India and Vietnam, the power consumption, tell it all. India down almost 10%, Vietnam up almost 6%. That's about the robust. But macro is going well. But if you don't have market stability, give me 1 second, guys. I think the screen is just moving around. If you don't have market stability, equity market, you don't make money, guys. So you look at the FDI pre-COVID, steadily increased. Export market, extremely well. Current account surplus has been almost 8 to 9 years already. That is no wonder why currency reserve is at the top level now. And as a result, the dong has been very solid in the last 10 years. Before COVID, Vietnam has low international debt, so does local debt. Even more impressive, if you look at different indicator, you look at Vietnam currency reserve over external debt has been significantly improved in the last 10 years. In 2019, look at this ratio, compare it to China, with almost better, double better than China. And that explains why the currency has been rock solid in the last 10 years. How about during two months of COVID? How the domestic stability look like? First, look at the equity market. The biggest outflow ever, almost $800 million outflow. 6 times higher than 2008, almost 3 times higher than 2016. But that's equity market. Look at the real FDI, real economy. FDI committed is almost the increase significantly compared to 2019. This surprised almost everyone. And no wonder, currency reserves still record high. Without the big intervention into the currency market from a central bank, the currency, local domestic currency, still one of the best one compared to other emerging markets. That's the macro level. Let's go back down to micro level. How the COVID-19 may impact companies level. On the big company, debt equity ratio, lowest ever. Cash flow very positive, so there's no worry on the big companies. On the smaller companies, small medium enterprise, the worry is there. The debt equity ratio is low, but still way higher than the big companies. Operating cash flow, profit cover 9 months for the operating, but about 20% of companies may face difficulty in the next 2 months. Let's look at how the government responds to COVID-19 economically. First, on the central bank. I think one of the best things the central bank did is they freeze all the loan. They allow banks to retract the loan. This is similar to what the Fed in the US intervened the credit market. On the interest rate, they cut 50 bp a month ago. Yesterday, they cut another 50 bp down to 3% right now already. But the focus is not on the monetary policy, but rather on fiscal. The disaster relief package, $2.7 billion or 1% GDP, helicopter money, already approved. And surprisingly, 2 days ago, a few people already received it. The speed of give the money from the government to the people surprised me. Quick. A 3% of GDP, not yet to be approved on tax cut and land rent, but I think it should be approved. The thing I want to tell you today is not about disaster relief, but rather infrastructure investment. Because that's, for me, is a focus. In the last 3-4 years, the big amount of money from state budget for infrastructure investment has been sit at the bank, not been disbursed to infrastructure. Currently, because of COVID-19, the government allowed $30 billion authorized for infrastructure investment in 2020 to 23. A condition for doing it, currently right now, fiscal deficit only 3.4%. Public debt is 55%. Bond yield is low. Guys, time to borrow money. Given all of that, my forecast, which has been for 2 months already, I haven't changed anything, is on the worst case scenario, 2.8% growth. On the base case scenario of 4.9%, which is quite consistent with what the Prime Minister just announced a few days ago. I think my best case scenario could be unlikely to happen given US and Europe situation. However, I think it's worth to look at the 2 worst sectors, which might create instability for macro environment, which is aviation and oil and gas sector. I talk about these 2 sectors because I want to look at the 2 worst sectors ever to see whether it can create any trouble for the economy. First, on oil and gas. Of course, this year they're making loss. But look at the balance sheet. The total debt is extremely low compared to cash level. And you look at the EBITDA, at even the $20 per barrel, they will be well covered interest expense ratio. So it's not a problem at all, in my view. Bad profit, but liquidity is good. The more troubled sector is airline, which is, we believe, are running out of cash. The cash level for the 2 biggest listed company, Vietnam Airlines and VietJet, will be good for the next 4 to 5 months only. However, what we believe is the government and the bank will step in to lend them money. So yes, making loss, but bankruptcy, forget about it. So let me conclude. On the COVID-19, we did an excellent job. On the civic sector, it got hit, but rebounds quite fast. On the Mediterranean sector, I would say great, because we are taking market share from all the country. From a market stability, financial stability, as good as ever. On the sector, some sector making loss, but the danger to create instability for the sector, for the economy is low. And I end my presentation. Over to you, Bill.
I can't get my video. I need for the host to unlock my video.
Bill, I think you need to unlock
Okay,
your,
thank you. My name is Bill Stoops. I'm the CIO of Dragon Capital. Today, I'd like to talk about our views on the outlook for the market and then briefly introduce the Vail Fund. Okay, so going into COVID-19, the market had been consolidating nicely in a 950 to 1,000 range for the previous 2 years. We thought it was well positioned for a breakout, but then the virus struck, so we plunged into the 600s, but then we've rebounded along with the rest of the world. Today we're up about 35% from the low at 845. And our analysis of flows indicates that it's way more the foreigners than the locals who have been selling out. So you can see in this chart how foreigners relentlessly dumped stock after the virus took hold from 31 Jan. And up to 30 April, they unloaded about $710 million worth of stock. And until recently, they were still going for it, although they are small net buyers now. And how did that compare with locals? Well, I'm not going to say that the retail contingent rushed in to do cheap buying in the January-April period, but they did only net sell about 110 million. And more importantly, near the bottom of the market in March, there were huge buybacks by companies and especially by management, about 720 million worth. And there's still 165 million in registered buybacks waiting to be done. So locals, left to themselves, are inclined to be a little more bullish about their own stocks. And a further point is that retail players, having been net sellers, are cashed up, as opposed to having spent all their money, and they're in a position now to support stocks if downside recurs. Now, what about earnings? Dragon follows the top 60 investable companies by size to monitor the market, and those companies are about 70% of the combined 3 stock exchanges, maybe 85% of the VNI. And for 1Q20, the unadjusted top 60 earnings, by which we mean unadjusted for a float, were down 25%, so quite a drop. But this primarily reflected 5 giant energy and transport companies that are 12% of market cap, but only about 5 or 6% of market float. And they mostly had huge losses or hardly any profit, and they accounted single-handedly for 105% of the unadjusted earnings decline. And without them, 1Q20 earnings would have been up by 1.5%. And if COVID is contained the way Dr. T foresees, we think that the top 60 raw earnings will improve Q by Q and finally be just minus 9% for the full year. Now, if you look at adjusted earnings, that changes the picture a lot. 1Q20 adjusted earnings were only down about 4%. When you take out the 5 companies, you get plus 8%, and the full year number becomes minus 3% only. Now here you can see our full 2020 projections. You can see the minus 3% for 2020 near the top of the column. That was plus 17% when we started the year. So we've cut a lot, but the resulting PER of 10 times, or maybe more like 10.5 times for today, seems undemanding if there's any kind of rebound from COVID-19, and 10.5 times is historically low for Vietnam. Versus Asian peers, Well, forecast revisions are not in yet, but prior to COVID-19, Vietnam regularly showed a more attractive value growth profile because it's still in this process of re-rating and converging. And I can only think that it's become more compelling after the successful containment of COVID-19 and the potential to poach even more FDI from China. The market itself remains on a very healthy developmental track. Vietnam has long since outgrown the MSCI Frontier market classification. After all these years of earnings growth and new listings, it's ahead of many MSCI officially designated emerging markets, as you can see in the charts for size of market cap and volumes of turnover. It is true that privatization has lapsed since mid-2018 due to the anti-corruption probes, but there's a $15 to $20 billion pipeline of IPOs and secondary divestments waiting to resume by mid-2021 with the change of government. So only foreign ownership limits, or FOLs, now hold back the MSCI emerging designation for Vietnam. So on to FOLs. We know that non-voting depository receipts, NVDRs, will be introduced to rationalize FOLs, and that's great, but it's not going to happen before 2022 or 23, which is less positive because MSCI inclusion won't happen until then either. But meanwhile, the government has been quietly authorizing funds that circumvent their own FOLs. There's two structures here: local funds packaged out to foreigners through feeders offshore, and fully local ETFs that foreigners want to buy locally. And the government's doing this because it knows the problem needs to be dealt with sooner rather than later. But the issue is complicated. So here's the perfect stealth solution: backdoor entry with tacit government approval. And these structures will give access to FOL stocks without premiums, without liquidity hassles, without illegality, and they're going to be a big deal when things return to normal. So you can see how much foreigners already own, 28.5 billion at present. And as much again could come in again once these things start rolling, 20% of market cap, a lot more of the float. And that will be great news for FOLs, for FOL stocks, which are about 40% of Vail's AUM. Now that's a good point to segue into Vail. I'd like to introduce the fund very briefly, then we'll hear from the analysts who support it and the PMs who run it. So Vail has AUM of 1.2 billion. Of course, it's been listed in London since July of 2016. It's a closed-end fund. In the past month, it's probably traded on an average discount of 10%. It's actively managed. It's run by a senior PM with 20 years of experience and his 2 deputies. And it's supported by 15 analysts, which is Vietnam's biggest buy-side research team. As our flagship fund, it exemplifies the way we manage assets. Dragon is a research-driven house. In a nutshell, we look for value for growth. We identify the key top-down macro drivers. Then we select the companies that best channel the growth they create on a bottom-up basis. So in our view, Vietnam's story is the creation of a modern, mass middle-class economy led by the private sector. The market doesn't have many exporters because the fact is that the great Vietnamese export machine is either FDI and owned by foreigners, or a lot of mom and pop workshops, so too small to ever get listed. So the market is all about the domestic economy. And this generates 3 basic domestic investment themes: consumption, financial services, and urbanization. You can see how they're reflected in the Vail Fund. Big overweight of consumer, kind of neutral on banks, modestly overweight on urbanization. But don't get too distracted by this, because what determines performance is company selection, not sectoral allocation. So I'd like to ask our analysts now to discuss these themes and some of the companies, obviously very briefly. Then a deputy PM for Vail will tell us how the managers wrap everything up into portfolio construction. So over to the analysts, starting with our man on property.
Hi, this is Ming Ching. I'm the property analyst with Dragon Capital. Please allow me 5 seconds to share my screen. Okay, I would like to give you a brief update on the sector situation during the COVID-19 and our view post-pandemic. First of all, some backdrop on the sector pre-COVID. We think the sector was in good shape, but not without challenges. Urbanization and middle class expansion are still the key drivers, with mid-range remains solid, strong demand and high absorption rate. Compared to previous cycle, market had consolidated and the survivals has much stronger financial position. However, the policy was not favorable in the past 2 years. The anti-corruption drive made it difficult to obtain construction permits. Tightened lending from banks forced developers to exercise capital discipline, and slow infrastructure spending led to slower creation of new urban areas outside cities. This led to limited new supply and elevated price. Coming into the COVID-19 pandemic, this was unprecedented short-term impact to the sectors. Most developers we talked to went into hibernation or survival mode. As you can see, the pre-sales plunged in both Hanoi and Ho Chi Minh City. However, the good news is that we do not see property price decline en masse, rather remain stable with fewer transactions. The condotel is the hardest hit segment. As per Dr. T mentioned, the hotel occupancy dropped near zero and the tourist arrival plummeted in the first 4 months. Going forward, this segment will continue to be under pressure in our view. Having said that, we believe the property developers have become much financially healthier versus previous cycle, so the systematic risk is not high. Look at the chart on the left. The net debt to equity has declined to 30% versus previous cycle, whereas the chart on the right showed that developers now have more financing options through bond issuance versus previously. The government also signaled that they will provide strong support such as delaying tax and land use right payment, preferential lending program. This will help short-term liquidity. Therefore, we believe those who can survive this pandemic will have great opportunity to gain market share. The reason we said that is because we believe post-COVID-19, the middle class story will still be the main driver for property market. As you can see on the chart on the left, home price to income ratio is not high versus regional, whereas the income has risen in tandem with house price, so the affordability remains reasonable. Out of the 5 key pillars for Vietnam property market, we already mentioned the middle class is good, macro is stable. Now we believe that the infrastructure, spending and policy, i.e. loosening the project approval process, will be the government focus post-pandemic since they have a strong incentive to stimulate the market. This is good for property market. On the longer horizon, Vietnam property market has bright prospect. We compare Vietnam with China in 2017 and see some similarity. While Vietnam has slightly lower score, we expect a similar trend of solid development with 10 to 12% property sales CAGR in the next 10 years. Therefore, we believe this is a good opportunity for premium names within the sectors. We highlight our 3 topics: Vinhomes, Khang Dien, and Đất Xanh. They are all the best names in their respective segment. Vinhomes, we already know, a property giant, create a model of affordable housing in Vietnam. Khang Dien is the top mid-range developer in Ho Chi Minh with great execution and large land bank, which is enough for 10 years of development. Đất Xanh is the #1 broker firm in Vietnam with successful transition to property developments. These 3 names share 3 things in common: very strong balance sheet, strong 2020 earnings, which may even surprise the market, and sustainable long-term team. The valuation, as you can see, is cheap, not just versus themselves, but versus peer. That's the end of my presentation. I would like to hand over to Đức, our bank analyst, to talk about bank sector.
Hello everyone, I'm Đức, the banking analyst for Dragon Capital, and let me provide you some color on the banking sector amid the COVID-19 pandemic. Let's start off by saying that Vietnam's banking balance sheet has been transformed in the last 5 years. By 2020, all banks will have to comply with Basel II. Deleveraging has been a trend and will continue onward thanks to multiple subsections of the private placement. asset quality also improved significantly. With the last crisis-related bad debt is now mostly resolved. Also, NPL coverage ratio increased sustainably, much better cushions for potential systematic shock. Although, as you can see, banks are entering the pandemic with a much more defensive state than they did in the 2011 last credit cycle. Better asset quality and solvency comes with a prudent risk management practice. Unlike the credit market in the West, with high proportions of unsecured loan, Vietnam banking relies heavily on real estate market, with 80% of collateral being real estate. At a safe value of loan ratio, collateral value to loan ratio of 150 to 200%. If the property market is healthy, we believe that banks are in very good state. We took a proactive approach to understand the potential bad debt level within the system. Instead of calling for bank CEOs and CFOs who will provide a distorted reality, we spent a week reaching out directly to lenders and risk managers in large bank branch. It is estimated that the proportion of restructured loan is to be about 3 to 5% by Q3 of 2020. If COVID-19 is under control by 2020, bad debt is not the problem. Some of these 3 to 5% will be bad debt, but the system can deal with it. But if the virus does not get better by year end of 2021, it will be a concern. Yet, we must remind you that the economy is strong, collateral asset is liquid, the banking health is best in ever, and the government control of COVID-19 is excellent. So we believe that the shock will be there, but the impact will be softer than the last cycle of 11 to 12. The impact of COVID-19 on the banking sector is still imminent. However, the magnitude of the impact will diverge among banks. With lower leverage and higher NIM, the full-room banks are the most cushions for the pandemic. The state-owned banks, not very high level, but they have a state's own unrivaled competitive advantage, and also will be more sheltered versus the COVID-19. The pandemic will hit the hardest to the other banks, or the smaller ones, which have no competitive advantage. Not only being the least impacted from the COVID-19 with better asset quality, the full-room banks are now trading under book value and only 5 times a PE on average, while their sustainable ROE stay at about 20%. These are our top favorite names in the sector and also are highly overweighted in wealth. The state-owned banks, on the other hand, are not cheap, but they have unrivaled competitive advantage, such as Vietcombank, which justify for its premium valuations. Overall, our conclusion is that given the well-controlled COVID-19 by the Vietnamese government, the economy is picking up very fast, and we see banking sector appealing at this level with solid fundamentals and good future prospects. The large banks will prevail as winners after the pandemic, whereas the smaller ones will struggle. With that, I end my presentation and hand over to Ms. Trang for some color on Vietnam infrastructure.
Thank you, Đức. Good morning, everyone. Hi, I'd like to start next on Vietnam infrastructure. My name is Trang, and I'm from the research team of Dragon Capital. On the topic of Vietnam infrastructure, the activities have been muted in the last few years due to political reasons. As a matter of fact, Vietnam underspends in infrastructure relative to many other countries in the region. Vietnam logistics cost as a percentage of GDP of 23% is 1.4 times higher than Thailand, is 2 times higher than Malaysia, and 3 times higher than Singapore. Our steel consumption per capita of 7% is the lowest level in the region. Understanding the logistics bottleneck, After winning the success of coping with COVID-19, Vietnam government decided on increasing the state budget in infrastructure, and it will be the key driver of the stimulus package. The government will also convert a number of projects from public-private partnership into state budget this year. We expect with this, the approval procedure for infrastructure projects to be a lot faster than before. As Dr. Tuấn mentioned earlier in his presentation, the government has set a budget of about 30 billion USD for infrastructure spending. This includes a 2-year budget of 5 billion USD, focusing primarily on the National North-South Highway project and the 2 metro lines. Much of the work relating to the highway project is expected to start in the next quarter. If you happen to visit Vietnam later this year, everywhere you go, I believe you see massive construction sites. We only have one highway at the moment to connect north and south of Vietnam, but the highway is pretty narrow. It runs through residential areas and is overloaded in volume capacity. The new National Expressway will be significantly expanded, and once complete, it will become the backbone of logistics, attract foreign investment, and create more momentum for socio-economic development. On this slide, you see a picture taken just last week of the very first metro line in Vietnam. The work quickly resumed right after COVID-19 quarantine was released and is 72% complete. This reconfirms the government's determination to boost infrastructure spending. Here is a very quick look over the future metro lines of Ho Chi Minh City, which will significantly help address Vietnam's overcrowded public transport system. Now, let's move on to discuss interesting infrastructure stocks on the Vietnam Index. There are a couple of ways to play around infrastructure theme. We have stocks in materials like steel and cement, stocks in BT development, or stocks in property development, as covered by my colleague Minh Chik earlier on. Across all segments, we see potential earnings growth, and the stocks trade at demanding valuation, pretty much cheaper than the index. We are reviewing ESG practice of companies in the materials sector, especially cement. We have Hòa Phát with ticker HPG to represent the steel sector, and the company will become the largest steel producer next year in Vietnam with triple capacity. With the mega steel complex in Dung Quất up and running now, Hòa Phát establishes major economies of scale and efficiency over its competitors. The stock trades at 7 times price earnings ratio with 27% 2-year earnings CAGR. Hòa Phát is our strong conviction for infrastructure, and the VIL fund is heavily overweight in the stock. This wraps up my view on Vietnam infrastructure. I would now like to pass on to Lý Vũ, our consumer analyst, who would walk you through the exciting sector overview. Thank you very much.
Thanks, Ms. Chang, for the introduction. Good afternoon, good morning. I am Lý Vũ, consumer analyst, and today I would like to give you a brief update on the sector situation during COVID-19 and our view after the pandemic. Vietnam consumer demand is shielded by the strong formation of middle class and capital accumulation in the past few years. There is an estimate of $100 billion hidden wealth among Vietnamese consumers. COVID did not weigh down the consumer demand for essential goods, and we expect a strong V-shaped recovery for demand in discretionary goods. Before lockdown, consumption spending in Q1 were very positive for essential goods, such as pharma, essential FMCG, and IT products, as people bought laptops and computers to work from home or study online. Discretionary goods saw a big drop except for jewelry, which was supported by strong demand on Valentine's and International Women's Day. During the lockdown in April, all categories declined, and discretionary goods have a larger drop than essential ones. We expect strong recovery V-shape for discretionary goods in May. Growth of discretionary goods in May is expected to be strong, except for automobiles. This is a big ticket item and often considered as a big investment consumers. Jewelry and consumer electronics had the strongest recovery in terms of month-on-month growth. And we anticipate consumer demand will come back to normal very soon as people is coming back to normal life. During COVID, we have seen a major shift in consumer behavior. People spend more in modern trade and online channels. This creates a golden opportunity for these channels to gain market share. And in fact, they gain 2% market share from general trade. This is a huge increase as it normally takes 3 years to gain such increase for modern trade. We believe that online channel will not replace the offline any soon, as it is holding a small share and its key growth driver for online during COVID was essential goods, which is the same as modern trade, while discretionary goods declined. This shift is benefiting the top retailers in Vietnam as they have been building a strong online platform to capture the future growth. Big retailers companies like MWG and P&J are consolidating the sectors and gaining market share. They have sufficient resources to develop online trades, and they are currently operating a very good online platform, especially MWG. Also, with solid balance sheets, they continue to stand strong, while weaker players are being taken over or dying out. Top retailers, MWG, P&J, and biggest brewery, Sabeco, the largest dairy companies, Vinamilk, are holding 14% of the VN Index. All companies are trading at attractive valuation, except for Sabeco. Vinamilk maintained very robust earnings in 2020 at mid-COVID, and trading at PER of 20 times, 15% discount to peers. Sabeco has its own problem when the beer sector has structural change in demand due to the stricter law on driving after consuming alcohol. We are overweighting MWG as we have a strong conviction that MWG will become a large player in the grocery sector that is worth $80 billion in Vietnam. In conclusion, we are seeing consumers' demand coming back strongly as Vietnam is resuming to normal quite quickly. This is thanks to the Vietnamese government prompt and aggressive action to prevent the pandemic. This will end my presentation here, and I would like to hand over to Mr. Tuấn Bùi, the DPM of VAIL. Thank you very much for your attention.
Thank you, Lee. My name is Tuấn Bùi. I am the Deputy Portfolio Manager of VAIL, and today I will talk about the VAIL portfolio, how we construct it, and how does it help us to have a very good track record of outperforming our reference benchmark, the VN Index, the ETF, and our peers. So as you have heard from our colleagues, 4 sectors have been presented by those that we believe will drive the structural long-term growth in Vietnam. And this reflects very well in the portfolio. We are the domestic consumption sector. We have a big overweight in mobile, the leading mobile phone and consumer electronic retailer, as well as a major player in the US dollar grocery market. We also have a big overweight in the leading jewelry retailer, Phú Nhuận Jewelry, and the leading IT service company in Vietnam, FPT, all of whom are in prime position to further consolidate their sector post-COVID-19. In the financial services sector, which is dominated mostly by banks, Out of the 18 banks that listed across all 3 exchanges, we only invest in 6 of the banks, and we overweight these. 4 out of these 6 banks that already have their FOL filled up, and these are the banks that we believe have superior asset quality as well as a great banking, retail banking presence, which is the most interesting part of the Vietnam banking story in our view. We also have an urbanization team, which include property and constructions, infrastructure, and and these sectors are poised to do very well in an environment in which the government is expected to boost infrastructure spending. As for the transportation sector, the 5% you can see here mostly came from the 2 main airlines in Vietnam, neither of which we have on VEL coming to COVID-19 outbreak. What we do have is a 2.2% long-term bet on the monopoly airport operator, which we feel will capture very well the increase in air travel demand as a part of the middle-class consumption team. When we at the VEL team started to realize that COVID-19 could potentially be a major problem for China, Vietnam, and the rest of the world, we took a very hard look at our portfolio investees in terms of their ability to survive this type of shock. And the result was quite encouraging, judging by the end of 2019 number. They were all on fairly solid financial footing, whether we look at their debt level, which you can see on the first chart, or their ability to service their debt and payable, which you can see on the second and third chart, or their short-term liquidity, which allowed them to continue operating, which you can see on the fourth chart. We then pick up the phone and talk to them directly to see how they are assessing the situation, and they all express confidence that their company can pull through this difficult period of time. Quite a few of them noted that they believe the impact of COVID-19 will help accelerating the consolidation within the sector. And as some of my colleagues have mentioned, they are quietly preparing to be on the front foot forward, so that whenever economic activity resumes, they can aggressively come out and take more market shares. In terms of portfolio constructions, the portfolio is fairly concentrated. Our top 10 holdings account for 61% of NAV. And because of our value for growth approach, on any given year, you would expect their portfolio to deliver better EPS growth in the market while trading as a lower multiple. So for 2020, we expect their portfolio to deliver 6.8% EPS growth in comparison to a -3% for the VN index, while trading at just 8.2 times PER compared to the 10 times for the index. VEL is also cheaper in terms of PBR while delivering higher ROE at nearly 19%. And a very decent cash yield of 1.7%. Since the start of the year, despite the difficulty of COVID-19, especially regarding the travel restriction, we were still able to complete a number of structured divestment to strategic buyers. And this had helped us to raise our cash level to around 4% at the moment. And given the drop in the market, we are now looking to go out and pick up on some of the names we believe can benefit from the economic resumption post-COVID-19. And it is on the back of the way we construct the portfolio to capture Vietnam's excellent long-term growth, where it has been able to deliver very good performance in the past. The fund has outperformed our reference benchmark in 4 of the last 5 years, as you can see on the chart on the left. And in terms of accumulated performance, we are mostly in line with our benchmark on a shorter term horizon, slightly behind the 3-year horizon, but way ahead on the 4-year and 5-year horizon, by over 13% in the 5-year horizon. And comparing ourselves to other Vietnam-focused investment peers, VEL is the best performing fund in Vietnam for the last 3 years. The outperformance is further widened for the 5-year and the 10-year horizon. And we've been able to deliver this strong performance historically on the back of a very rigorous environmental, social, and governance screening process, which we apply for every single investment we make in the VEL portfolio. At the end of 2019, we estimated that 16% of our investment universe were excluded because they did not meet our ESG screening standard. We we exclude companies that account for 50% of the market cap in the materials and resources sector for ESG non-compliance. And historically, we have screened a total of 92 companies in our investment universe, and over 40 investees in their portfolio have been either newly screened or received an updated screening in the last 12 months. And lastly, our screening checklist includes 41 in-depth ESG questions. And so as a final word, with everything we have shared with you today, we firmly believe that the Vietnam story will continue to do well post-COVID-19, and looking at where we position ourselves in the sectors that drive the domestic economy, VEL should continue to do well with it. Thank you. Over back to you, Bill.
Thanks. Thanks very much, Tuan. Thanks very much to all colleagues. And let's throw open the floor for a few questions. There's over 100 people, I think, still with us. So I'd encourage you, if you do have questions, we do have some, to keep firing them in. So to start off with, one for Doc T. So this is related questions in a way. So China plus one. Is this a new theme? In fact, we heard that in the time of SARS, didn't we? Are we likely to see this theme reopening again? And in relation to that, to what extent are your assumptions for future GDP growth dependent on relocation of supply chains? And if you've got time to answer those two, maybe we can stick another one in there as well, which is, can you comment diplomatically on the Chinese-Vietnamese relationship? Leave you with those three to start with.
Right, Dominic, thank you very much. Regarding the China Plus One strategy, it's not new. It has happened in 2010 when China and Japan got a problem with rare earth material, and that is accelerated when the TPP is negotiated. And then you have Trump came in 2018. It's another round of China Plus One strategy. And now, given Japan, Europe, and US pushing China to the corner, I would say China Plus One strategy will be stronger as ever. So Vietnam and all the countries could benefit from it. How big is the GDP impacted? I would say it could be significant. The reason is because you look at it this way. You look at infrastructure investment has been a key problem in Vietnam. That has been the bottleneck for economic growth and for cost of logistics. And that could be unlocked soon, as I presented previously. So the GDP impact is not only from FDI reallocation, but that also compounded with the infrastructure investment in Vietnam. So that could be, I would say, 5 to 10% additional GDP could be imaginable. Regarding the second question on the China and Vietnam relationship, I think that's a good one. The answer for that is, when it's more like you and your wife, or you date a girl, hate and love all the way. And Vietnam and China, the love and hate relationship has been for 1,000 years already. Okay, from Vietnam side, I think it's important for Vietnam to work the balance between China and the US. So we have been, if you want to give a reward, or Oscar reward, or the Nobel Prize for Vietnam in terms of international relationship or international policy, I think Vietnam should be the one, because we have been balancing so well between China and the US. But remember, it's not only about Vietnam though, it's also about China. If China try to push Vietnam to the corner, they don't want it, because Vietnam is the only country in Southeast Asia which is extremely, which is strong enough to make trouble with China. If you take Cuba, for example, close to the US, and you take Cuba multiplied by 20 times, that's what you have Vietnam next to China. So push Vietnam to the corner, meaning Vietnam will team up the US and Japan. That's not a good idea for China. So I think the balance, we will keep balance for 50 years to come. So nothing to be worried about it. Over back to you, Dominic.
Yeah, thanks, Doc T. Can you prepare some comments on FX stability? Well, I just pick up a question on political stability. So it's an important feature of Vietnamese life, the political system. And as many of you may know, we run in a 5-year political cycle. So at the beginning of next year, unless it's postponed, I don't think there's any reason for that, there will be a new leadership for the Communist Party that kicks off the change in ministries. It kicks off a national general election, which will also take place next year, and therefore a new National Assembly. And so there will be a new leadership to the country, and Hanoi in particular is full of tea leaf reading and rumoring as to who are going to be the components of the new leadership. I don't think we should speculate on that now because it's just too speculative. But what we can say is that the new leadership that does come in will be in all significant aspects pretty much a continuation of the current leadership and its policies. So that's politics. Over to you, Dr. T, on FX.
Can I make a quick comment on that, on the political stability? 2011 is the time when the Politburo transformed the party from state-owned enterprise focus to private sector. That's a big battle. From 2016 to 2020, it's more like the transformation from restructuring institution and anti-corruption. 2019 probably is the peak of anti-corruption already. So 2021 to 25, I would say you guys should be positive on political stability, much more than the previous two regime. On the FX policy, actually, Vietnam should depreciate the currency a bit because our currency right now has been stable against a lot of different countries in the emerging market. The key thing is because Vietnam become more competitiveness despite the currency stable, but our productivity improve, so the currency competitiveness is not losing out. Implication is even Vietnam want to depreciate, but the inflow has been strong from FDI, from remittances, from import-export, has kept the dong a bit stronger. So my forecast in the next 3 to 5 years, if you be conservative, you take 1.5% depreciation per year. If you be a bit more bullish, you take 1% or 0.5% per year depreciation. And that's, you will get it correct. Thank you.
Thanks. We've got quite a few macro questions, so stay on, Dr. T. Here are some related ones. Who are Vietnam's natural competitors? And what are your views on the development of intra-Asian trade? Of course, bearing in mind that Vietnam is chair of ASEAN this year, isn't it?
Yeah, I think on the intra-ASEAN trade, it's positive. It builds a trading bloc, but I would not be too bullish on that. The reason is when you trade with one country, you need to have a competitive advantage. Like when Vietnam trade with the US, there is clearly a competitive advantage between the two countries. If you trade with against Thailand, I don't see there's competitive advantage. So from that perspective, ASEAN trade link, I think it's an okay thing to have. It's not the thing to push Vietnam road much. So that's my answer for that question. And Dominic, can you rephrase the first question?
Who are Vietnam's natural competitors?
Oh, that's a good
as nations, economy.
Extremely good question. Used to be in terms of manufacturing, could be China, right? It's big and it's competitive. But right now, I think Vietnam is benefiting from China diversification already. So I think the biggest competitor right now, still China in terms of manufacturing, but I think India, Indonesia, Thailand are the key competitor for the times for the years to come.
Okay, one interesting feature here, and this is also reflected in a question, is what are our views on aging? Maybe I can take this one. Well, Bill, asking you to prepare some comments on buyback strategy, if I may. For many years, while we've been here in Vietnam, the billboards are full of signs saying every family should have either 1 or 2 children. About 2 years ago, that changed and all the old posters were taken down and new ones went up going, it's the responsibility of every Vietnamese citizen to maintain a stable population, rather cleverly phrased. And this was replaced just 2 weeks ago with a new set of very, very explicit measures encouraging people to marry by 30, to every woman to have a child by 35, and the numbers not to be limited, and for those people who don't have children to be hit with all sorts of extra social charges. That gives you some idea of the thinking in Vietnam about demographics. Our own figures, I think, show that the workforce and the population crossover in about 2024. So clearly Vietnam is in the latter the latter stages of its workforce growing by 1.5 million a year. Bill, if you could unmask yourself, sir. We have a question here. What is the policy of Vail towards buybacks? And of course, as you mentioned in your presentation, you did focus a little bit on Vail, and that's quite correct, because of course Vail is not only our flagship fund, as you said, but it's coming up to an important AGM on the 18th of June, isn't it? Over to you, Bill.
Okay. Well, Vail likes to benchmark itself to peer funds in the trust class in London, and especially to other emerging market closed-ended funds, and obviously with specific targeting of Vietnamese and Southeast Asian funds. So that's its asset class. It certainly doesn't want to be out of step with whatever the prevailing discounts are. And whenever we think that we are pushing the envelope, we will do buybacks. But Vail seems naturally to stay within the range of its counterparts, and we haven't had to do very many buybacks in recent years at all. Generally in our minds, I think we have a sort of range of 10 to 15%. And ever since we got listed in July 2016, it hasn't been that much of an effort to stay there. I think this year we've only spent a few $100,000 to nudge the discount in whatever direction we thought appropriate. Well, we always try to nudge it down, of course. At one point, of course, we gapped out with the rest of the fund class, in March to around 25 or 27%. We did some modest buybacks, but then the market itself helped us to get back into the 10 to 15% range, and it wasn't too long before we got back to 7%. So we snapped right back from the lows we hit earlier in the year. Currently, we're I think 12%, and we're very comfortable with that level, and it's kind of the natural range for Vail right now.
Thank you, Bill. Can I take a few questions to our research colleagues, please? Trang, maybe you could unmask yourself. We have a question here. Hoa Phat, the share price has moved quite a lot in recent times. What's your view about how much further upside there is on Hoa Phat? And I'd like to tack onto that a question about ESG, which you mentioned, and also Tuan Bui mentioned. What sort of particular ESG issues do you run into in the materials sector? Two questions there. Minh Trinh, got a question on tourism coming up for you.
Thank you, Dominic. Right, for the first question, I think you're spot on Hoa Phat, stock performing very well in the past 2 sessions. It doesn't really prevent us from forming a view that the stock continues to offer upside in a 2 to 3 year prospect, very simply because we are very confident with Dung Quất complex coming in full now. Hoa Phat would be ready for triple capacity expansion, and would be the first, to consolidate market share in the steel market of Vietnam. So with that, even after running very strongly in the past 2 sessions, the stock still trades at compelling PER of 7 times only, and it offers a 27% of 2-year earnings CAGR. So yes, to conclude, we are still very convinced on Hoa Phat's stock prospect. Yep. On the second question regarding ESG on material stocks, we, as part of our screening, our investment screening procedure, we always maintain an open dialogue with the company's management, and in the steel industry in particular. Let me give you an example of how we do it, right? So if you recall, in 2016, when Formosa was probably the largest steel producer in Vietnam, they ran into some environmental issues with waste water treatment, and it did cause some pollution to our seawater. We followed suit on the case, and we had a very thorough and open dialogue with the management of Hoa Phat. And it was just right before they commenced on the construction of Dung Quất complex. Now, Dung Quất was at full ramp up last year already, and it is now under the strict surveillance by the Vietnam government with respect to environmental compliance. And we visited the project. We continue to keep the dialogue open, and we were actually quite impressed to learn from the management that they introduced nitrogen dry cook stamping technology already at Dung Quất. And this is a lot more environmental friendly than the traditional wet coat stamping technology. Now on cement, we met with Ha Tien One, or VSAM Ha Tien One company management last week. The old factory of Ha Tien One has been removed, and it helps to address major ESG concern on Ha Tien One. VEL is not invested in cement or Ha Tien One yet. We continue to assess the company's ESG practice as part of our full investment screening process, and we will keep you updated. Thank you.
Thank you, Trang. So important point there, it's dialogue. Yeah, thank you very much. So Minh Trinh, here, a question which I hope you can tackle. So tourism has obviously been bashed deeply on the head, and you talk about the condotel sector. And of course, tourism will recover. But do you think there'll be any long-term impacts on the hospitality industry? And how big do you think that is as a section of the real estate sector in particular, and perhaps the economy in general? Thank you. Over to you.
I think first of all, the condotel was badly hit, and as I mentioned, in the short term, the international tourist arrival will, as we can see, the flight has not resumed. So we still believe that the sector is still under pressure. However, the tourist sector itself holds less than 2% of GDP, so which is quite small in contribution. So whereas we see that domestic flights has already resumed about 60 to 70% to the normal level, and we will resume the connection to Northeast Asia and the country that are successfully controlled the pandemic sometime in June or July. So moreover, the hidden private wealth, as mentioned in Lee's presentation, and the saving of the Vietnamese consumer will have cushioned the consumer demands. Back to you.
Yeah, thank you very much. TB, prepare yourself for a question on tech companies, e-commerce tech companies. Well, I just add anecdotally for anybody who's interested, I am actually an investor in a personal capacity, an investor in a resort on an island off the south of Vietnam. We have 45 bungalows, 140 staff. It's been atrocious because, notwithstanding Dr. T's comments about the government handouts, they've taken quite a long time to get all the way down to distant areas. And so we've had 140 people on furlough for 2 months. But we are open again, and we're running now weekdays. I should say our clientele was almost exclusively North European, so we've been badly hit on that front. But our clientele now is, our rooms are about 15 to 20% occupancy in the week. No, more like 15. And at the weekends, we can get up to 40 or 50% occupancy. And that's really with young Vietnamese families from Hanoi and Ho Chi Minh, some expats. So there's an interesting anecdotal dynamic there. It doesn't yet make us sleep easy, but you can see that things are beginning to happen. So tourism. TB, question here. Much of the market recovery in global markets has been led by e-commerce, tech companies, FANGs, that sort of thing. So where are you? Where is Vail? Where are we in Vietnam on that sector, those topics, those companies? Yours.
Okay, thank you, Dominic. So for Vail, we have about 4.5% of NAV invested in FPT, which is the largest IT services company in Vietnam, with 40% profit coming from our software outsourcing segment. The company is expected to benefit from the COVID-19 as the needs for the digital transformation accelerate. We would also like to note that FPT clients are very well diverse across US, Japan, and the European, and more than 30% of their revenue come from Fortune 500 companies. FPT will also be a beneficiary as the company, other company diversify from China. FPT, however, is just over 1% of the index, and curiously, the tech sector is, as Andrew asked in the question, is kind of absent from the whole weighting of the index. So the biggest sector in the index are properties, banks, and domestic consumptions, as we overweight in our portfolio. The reason for the absence of the tech sector in the main exchange and in other exchanges as well is because of the listing requirement. So we would expect most of the big tech company in Vietnam satisfying the requirement for the minimum charter capital, which is around $5 million for the main exchange. However, in Vietnam, both the main exchange, HOSE, and the second exchange, which is the Hanoi Stock Exchange, require company to be profitable at least 1 to 2 years before listing for them to be able to list. They also have an ROE requirement of at least 5%, no accumulated loss. So it is these requirements that are preventing tech company to list on the main exchange in Vietnam. And so the rebound from the low of COVID crisis has been leading by banks, traditional companies like banks, consumer companies, and real estate companies, rather than from the tech sector like in the West. Thank you.
Good on you, thanks. So yes, so essentially it's not quite suiting the public markets yet. We've run now 75 minutes. We do still have people on the call, so if there are questions, please keep them coming in. That's what we're here for. But if in the event that there aren't a great deal more questions, maybe CIO Bill, you might like to prepare a question. Do you have any closing comments that you would like to make? Meanwhile, Doc T, here's a question for you. A second wave of COVID-19. Obviously, Vietnam has done extraordinarily well in its suppression of the first. Well, I suppose we also talk about this, the second waves here, but what can you give us some guidance about later in the year, next year, future flare-ups, how Vietnam's going to tackle that?
I don't think that's going to be a problem. The reason is we still impose a restriction on international flights to Vietnam. Everyone go to Vietnam to be quarantined for 14 days. In addition, any infected case of the virus could be quarantined, and the testing capability has been increased significantly in Vietnam. So I think we can, if it happens one more time in Vietnam, I think we'll be able to isolate quickly, and then basically not flatten the curve, but rather crushing the curve quickly. So I don't think that could be a problem on second wave in Vietnam.
Thanks. I mean, maybe I could add to that again, anecdotally. There's the lady I know in Ho Chi Minh City who had a friend to dinner in her apartment about 2 months ago. And at the end of dinner, her friend got up to go and was not allowed to leave the building, and so became her house guest for 2 weeks. Quite amusing when we look back at it. Perhaps it wasn't at the time, but that's an example of the sort of approach that Dr. T was talking about. Bill, do you have any comments you'd like to share with us? Because I think we're coming to an end, man.
Sure. I'd like to pick up on what Dr. T said. Ultimately, you know, Vietnam is going to be subject to whatever happens in the outside world based on COVID-19, right? So if COVID-19 is going to persist into 2021 and we're going to have 2 or 3 waves, you know, Vietnam's not going to be immune, right? It's going to be impacted ultimately, if only through the export link and the demand shock that might result. And that will ultimately feed into Vietnam's GDP growth. But if COVID-19 ends up being somewhat benign, if the vaccine we've been hearing about recently works out, then you know, Vietnam is better poised than any other emerging market to bounce back and take advantage of positive trends in the world. And also, if COVID isn't so benign, Vietnam is now hermetically sealed off from it as a more or less virus-free country with its own rather buoyant domestic economy. So it's got a buffer as well against whatever may happen in the outside world. And it gets back to the theme which we've propagated for several years now, that most of the risks for Vietnam are external rather than internal. So that would be my final take on.
Bill, stay there, because we've had a question coming in that comes from that, man, which is in the presentation there is reference to hidden wealth, and the question is, to what extent is this hidden wealth emerging into the banking system? Can you comment on that? And into circulating around through sort of consumer credit? And are there any banks that are doing this well? I don't know if you've got a comment on that.
I have my own thoughts, but I think it might be much better to turn that question over to the expert on the banking system, Mr. Duc Le Minh, perhaps supported by Dr. T. Let me mask myself.
Okay, thank you, Bill. So first of all, the number that is estimated by our research teams for the hidden wealth in Vietnam is around 100 billion USD. We do believe that this number will channel back into the banking sector and especially to the consumer credit segments. However, the exact numbers for this is very hard to identify. So, the magnitude is, we believe in the trend, but we do not have the cannot quantify for the numbers. As for the consumer credit, in the last 3 years, this is a major trend in Vietnam. As you can see, a lot of banks are now having another consumer credit company, such as FA Credit in VP Bank and M Credit for MB Bank. We believe strongly that these companies are very good fundamentally, and in the future, as Vietnam middle class is getting richer and consumer spending is still a very good trend, we see that this company will grow significantly and will still have very, very good future prospects. As such, we believe strongly in the futures of the banks related to this company as well.
Thank you, Dirk. Thank you. So maybe coming up to our last question here. This one's for you, Lee. No, we've got another question as well. So Lee, consumer sector, Vietnam, very open trading economy, lots of exports, but lots of imports. Can you comment on the extent to which Vietnamese consumer companies are able to resist inroads from foreign producers? Maybe you could comment on that. Thank you.
Thank you, Anh Dom. We have observed lots of foreign imported brands in Vietnam in dairy and beer. All the big players are here already. And competition has always been fierce in the FMCG sector. However, the key success to this sector is efficiency in production costs and distribution network. The company that has the most efficient product cost, thanks to the manufacturing facility located within Vietnam and the deeply rooted a nationwide distribution network, can ensure the significant market share. And Vinamilk and Sabeco have been very successful in capture market share. Vinamilk at the moment is holding 60% of market share, and Sabeco is holding around 40% market share. And those local branded companies are doing very well, gaining market share as well as defending it. So we're not so concerned of the foreign imported brands because they're already here. All the big brands are here, and we are already like in dairy sector and beer sector, we are the big players.
Good on you. Thanks very much. Couple more questions here. TB, can you prepare to take a question on the currency exposure of investors in VALE to the Vietnam dong, particularly via the route of a sterling quote? Is there Vietnam dong risk, and is the risk of appreciation or depreciation? So prepare that one, please. Meantime, a question maybe for CIO Bill, representing our views on the markets, Bill. The market's up 28%. This question from Thomas, since March, possibly one of the strongest performers in emerging markets. Do you think there's too much optimism baked in today's valuations?
I think if COVID-19 turns out to be a plague on the scale of the Spanish flu of 1918 to 20, there's far too much optimism. But I think right now people are penciling in a more benign outcome for COVID. And now there's a lot of talk about the vaccine. So really it all hinges on that factor. And if the world is going to bounce back from COVID to some extent, if we're going to find ways of containing it or doing damage control on it and getting back to work, then I don't think there's too much optimism circulating on Vietnam. But if we have the worst case outcome on COVID-19, there's too much optimism in the world about everything. But look where Vietnam is. Next year we're penciling in 20 to 25% EPS growth. If things turn out relatively, if we just get back to normal, right, on the world economy, and that would give us a PER of something like 8 times in Vietnam, 8 to 9 times. So on that basis, no, there's not too much optimism. So it all depends really on what you make of the progress of the virus.
Something which our listeners and viewers will have their own views, of course. Thank you very much, Bill. TB, over to you with our FX question now.
Hi there. So about 95 to 96 of their portfolio, percent of their portfolio is invested in the stock market, which is in Vietnam dong. The main currency that we hold on our portfolios are either Vietnam dong or US dollar. So those are the two currency that we mainly deal with. For investor in VALE, yes, you do need to take a sort of a view of how or where the exchange rate between the British pound and the US dollar. But for us, we currently do not have any policy of hedging currency at the moment, either for the VND US dollar pair or for the VND or British pound pair. In the past, we have seen the swing of the British pound, especially during Brexit time, and perhaps this year as well, with the British negotiation ongoing, and that's affected our discount in the past. But for us, we are not, as investor in Vietnam, we are not doing any, we don't have a policy in hedging this currency risk.
Thanks very much. So we don't have the capacity to hedge. I also refer that question to Dr. T's point that we may actually see some form of appreciation of the Vietnamese dong in the future.
May I add a little color on that? One of the reasons why we don't have a policy on hedging is because the hedging cost for Vietnam dong against any currency is actually very, very high, and it would not be economic to do so.
Thanks, T. So we're at about 90 minutes now. We still have some people on the call, but I think we've run out of questions. So in the absence of any closing remarks, further closing remarks from any of the Dragon team here, it just remains for me to thank all of those who've joined today, stayed for a good long time, listened to our views. Thank you very much for joining. For those of you who are shareholders in Vale, we do have an AGM on the 18th of June, and that will be dealing with a wind-up motion, which obviously all of us here at Dragon would hope is rejected by shareholders. In the meantime, we'll be putting together some written answers to some of the questions that we've had today, and those will be followed up to all of you who've registered with us, together with the relevant parts of the presentations. Happy birthday, Ho Chi Minh. Thank you all for joining and wish you the very best of the rest of the week. Thank you. Goodbye.